Understanding terminology is extremely important to understanding the issues surrounding risk management and insurance. Terminology is also important to understand contract interpretation and construction. Both parts of the insurance definition are required to define insurance. Both the contract and the financial intermediation are required for proper operation. I compare this with social insurance programs and welfare. Social Security has the financial intermediation but does not have the contractual relationship, therefore it is called a social insurance program. Insurers have to define loss very carefully because they need to know when losses occur, where they occur, how to measure them, and the perils that can cause them in order to reasonably ascertain that the losses should be payable. The difference between direct losses and indirect losses are explained. Students must be able to differentiate between the two because insurance contracts do. Chance of loss is discussed in a statistical sense to prepare the students for the discussion of risk. Since objective risk and chance probability of loss are not the same, it is necessary to define this explicitly. Perils are carefully identified in insurance contracts because insurers have to define the causes of loss that they will pay for. With named peril contracts, the burden of proof to show the peril occurred is on the insured's shoulders. With an open peril contract, it is the insurer's proof. The word hazard is rarely found in insurance contracts. However, hazards are extremely important for several reasons. Much of risk management is designed to reduce the frequency and severity of losses. Pricing insurance contracts is heavily influenced by hazards. Factors that decrease the expected frequency or severity of losses for the group of insureds. I described the difference between physical, moral and morale hazards. The doctrine of proximate cause expands by court interpretation the extent of the loss paid by insurers. This doctrine forces insurers to pay losses that extend beyond the literal interpretation of the contract. So if the contract pays for losses by fire, all the damage caused by fire will be paid along with water damage, smoke damage and other physical damage caused by the firefighters. This is the case as long as there is an unbroken chain of events. That is, there are no substantial intervening factors to break the chain. Later on in the class, you will find that many insurance contract clauses exist to truncate how far the doctrine of proximate cause goes. For example, exclusions eliminating loss due to the operation of building codes exist. That is, even though the cost occurs because of the fire, the insurer will limit or not pay for those expenses. The term risk is used in a variety of ways. This list is non-exhaustive and the term risk is used in the insurance industry in each of these ways. The last one is used next to describe how the insurance industry operates with respect to being able to predict the expected dollar amount of gross losses. With the last point on the slide, I discuss the difference between objective risk and the probability of loss. These are not the same thing as commonly thought. The probability of loss is a point estimate of a relative proportion, whereas objective risk is a measure of variability around that point estimate. Objective risk can be measured by the standard deviation divided by its mean. The smaller this number is, the less objective risk there is and the better insurers are able to predict the result. This is analogous to a tighter statistical distribution around a mean. Insurers try to reduce their objective risk. The lower the objective risk, the better is their ability to predict the gross loss amount suffered from the pool of exposures. This chart shows what happens to risk as the probability of loss changes. The number of exposures remains constant at 10,000 in this example. The assumption is the binomial distributions happens or does not happen 0, 1. N equals the number of exposures, P equals the probability of the event occurring. The mean is equal to NXP. The probability of the event not occurring equals 1p. The standard deviation is equal to the square root of NXPXQ. In this case, risk is defined as the coefficient of variation, CV, and is equal to the standard deviation divided by the mean. Note that as the probability of loss increases, objective risk goes down. Also, when it is known what is going to happen, where the probability of loss is 0 or 1, objective risk is 0. This graph shows what happens with objective risk as the probability of loss increases. This graph is based on the data found in the previous slide using the binomial distribution. As soon as a small probability of loss is introduced, risk increases dramatically because it is quite uncertain as to what is going to happen. As the probability of loss increases, risk declines because you are better able to predict results. Remember, this is while keeping the number of exposures the same, 10,000. This graph demonstrates the law of large numbers. It shows that as the number of exposures increase, objective risk decreases. In other words, the ability to predict improves as more and more exposures are included in the pool. This is with the probability of loss remaining the same. This chart graphs objective risk given the sample size and constant probability of loss. Discuss the different types of risks. Pure risks are the ones subject to insurance coverage since people are not allowed to gain from the transaction. The reason why speculative risks are not generally insured is because it would generate the wrong incentives. Suppose firms were able to ensure the acceptance of a new product by the market. Why spend money on research and development if you cannot lose? However, as we discuss in the Advanced Risk Management chapter, modern risk management does encompass financial arrangements and hedges that involve speculative risks. Even though subjective risk seems unimportant due to its nature, an individual's mental attitude must be understood because it influences the underwriting and claims adjustment process, among other functions. The topic of risk management is introduced. Since the prior topic is risk and the potential for negative outcomes, it seems logical to introduce how companies and individuals manage their risks or exposures to loss. Risk management provides a framework for the process of dealing effectively with the exposures. There must be a balance between pre-loss planning for loss and post-loss use of resources to handle exposures efficiently. There is a continuous process of identifying exposures, measuring the potential impact, determining how best to handle the exposure, and implementing the decision. This is the first of 2 slides demonstrating a simple example of how a rate is calculated. This is the second slide showing how a rate is calculated and demonstrates the building blocks of the insurance premium. The insurance premium is composed of an estimate of the loss cost, an amount for administration and an additional factor for the risk the insurer faces, reserve. The insurer reduces the premium by an amount representing investment earnings. Using this slide, I stress what must happen in order for the insurance transaction to function well. There must be a balance between the money flowing in the form of premiums, and the money flowing out in the form of claims. The product must be kept affordable or the pool size will decline. What causes the insurance function to fail is discussed later. Cash flow underwriting occurs when an insurer prices insurance below its actuarial value and anticipates investment income to cover the losses and make profits. This is a dangerous practice since the investment income may not materialize if investment rates decline or losses occur. The ratios are measures of profitability and students should understand how they are calculated and interpreted. Loss ratio is the dollar amount spent on losses and loss adjustment expenses divided by earned premium. Expense ratio is the administrative expenses and overhead divided by written premium. The combined ratio is the sum the loss and expense ratio. Salvage is used to reduce the cost of insurance and is important in several lines of insurance including inland marine and automobile physical damage. To ascertain whether the benefits of the insurance industry is worth the costs, a list of cost sources is provided. The students need to recognize that the cost of operating the insurance mechanism does not include the losses that would have occurred anyway, which represent a large portion of the overall costs associated with the insurance product. The benefits and costs of operating an insurance mechanism is important. Is operating an insurance mechanism worth the cost? This non-exhaustive list provides talking points with respect to the benefits of the insurance mechanism. To illustrate the importance of the insurance transaction, I talk about what would happen if the industry did not exist with respect to these points. The problem of arson is used to illustrate how the insurance mechanism can be used to pay for social and other problems. Who really pays for arson or other losses is an interesting question. It also illustrates that insurance companies do not pay for losses ultimately. It is the pool of insureds, us, who are paying for arson and other intentional and exaggerated losses because of the sharing of costs over the pool of insureds. The insurance company is just the mechanism for collection, premiums, and redistribution of cash losses. The problem of arson is used to illustrate the redistribution of costs to the members of the pool.